I had a client recently who was able to utilize NUA within their retirement account, and we were both very surprised at the result. Watch on for an illustrative example, and if you have appreciated company stock in your 401k, definitely watch to the end. Hey everyone, I'm Andrew. I'm a CFA charter holder and CFP professional who spent the last several years helping ultra high net worth and high net worth investors with their complex financial lives. And what I do is I take the learnings from those thousands of iterations and I give them to you so that you can apply them to your own life. I'm also the owner of Lever Wealth Management, which is the financial advisor for people who scare financial advisors. I had this client recently who'd been employed at the same company for decades and had ascended through the ranks, and she had just done things the right way. Fortune 50 financial services company. Fast forward to today, she now has this impending retirement and significant assets in different buckets, but one of those assets was employer stock. Now, I think it's important for us to define our terms first. What is NUA? It's net unrealized appreciation, which is just a part of the tax code that gives some preferential treatment if you have employer stock with an employer-sponsored retirement plan. In her case, it's a 401k. There are also some options within ESOPs for private companies, employee stock ownership plans, although those many times have different types of restrictions and you really have to look at the plan document. But nonetheless, in her case, it was publicly traded company stock for a Fortune 50 company. The defining characteristics for NUA, because there are these details that you need to be aware of, are as follows. Any basis, what you have put into the stock, comes out into a taxable account as ordinary income. Okay, so in her example, we had $100,000 of basis and $500,000 of stock as a whole. NUA allows you to take that position and move it into a taxable account instead of rolling it into an IRA. Now the question is, well, why would you do that? Well, capital gain tax rates today are many times lower than IRA tax rates, which are all ordinary income. But when you pull it over here, the IRS says, hey, any of the basis that you'd put in there, that's going to be ordinary income. Now the $400,000 delta of appreciation is considered long-term capital gains from day one, which is different from ordinary securities, and there's no net investment income tax on it. There's no 3.8% Medicare surcharge. However, over time, this position does not get what other taxable securities get, which is what's called a step-up in basis at death. That, assume it's still $500,000 30 years from now, hope it's not, but if it's $500,000 and you had a $100,000 basis in it, your heirs would get a step up of the $400,000, so they had no tax liability, all else being equal. And hopefully that provides a little bit of context for the why somebody would consider it. And it helps us frame the input-output equation so that we can look at it and go, what would make this a slam dunk? And a slam dunk would be, you need taxable funds, but you don't have them right now for asset and tax diversification. And you have extremely low basis and extremely high appreciation. Now, to implement this strategy, you have to have what's called a qualifying event. Many times that's age 59 and a half, retirement, disability, death, that type of thing. In her case, it's retirement. And so when you look at this, you go, we have to actually run the math. It sounds great, but you have to run the math. Here's the interesting thing about it. When you pull the stock over to a taxable account, you introduce another set of issues. First and foremost of which is, now you have a concentrated stock position that most likely you need to get rid of. Now, if you have other diversifiers, that's a different story, but many times this is a large portion of your net worth and you're pulling it into a taxable account where you now have to pay taxes to get rid of that concentrated stock. I've done several videos on how risky it is to have significant portions of your net worth in one stock. And so many times the first recommendation is, hey, we need to get rid of this. So with that, you have to do a break-even analysis, and this is exactly what we did. We said, all right, we have the $500,000 of stock over here in the IRA. If we don't do anything, we don't have to touch this until age 75, when required minimum distributions kick in. And so let's say this grows at 6% a year. Over here, if we pull it over, we have to pay tax on the basis, and so that's going to lower the dollar amount that we have up front. And then in addition to that, what if we got rid of the position either in 1 or 2 tax years so that we're not over concentrated in one stock? And so you don't start with $500,000, you maybe start with $425,000. You see what I'm saying? In addition, because this was a financial services company, they paid a large dividend. Well, if it's now in a taxable account, any dividend that's paid, you have a tax liability associated with it. And so we're not making 6% like we are over here. We're actually making 5.5% when you associate it with the tax cost of the investment. When you look at this over time, even if the IRA had a higher ordinary income rate, and we're paying capital gains rates over here of 15%, even if we were paying 30% over here on the IRA side, there was never a break even. I'm going to say that again. There was never a break even in that situation. Now, the question is why? 2 specific reasons. The first was the assumption that we are diversifying out of the stock lowers the dollar amount at jump. And the growth rate on the stock, or even diversified portfolio once you liquidate the stock, has an associated dividend yield with it. And the tax drag from even a diversified portfolio is going to reduce the assumed rate of return over time. And so the compounded growth in those deferral years from age 59 to 75 far outweighed the lower tax rate over time, because this was able to compound 500 to 530 to 565, et cetera, whereas this started at 425 and compounded at a smaller rate, even if the associated percentage tax liability was less, 15% tax liability versus 30% liability. That's just one situation. And there are so many different iterative ways to run this scenario. But I want to focus in on that in one other distinct point, which is when you pull assets into the taxable world, especially concentrated positions, and you're trying to work through tax bracket management for someone, the number of years and the decisions we get to make are finite. And so in this situation, because of her asset base and different goals and objectives, specifically with Roth conversions that we'll be looking at, and possibly some donor advised fund contributions, you were introducing something that possibly had a good outcome, but wasn't a slam dunk, whereas some of these other decisions for her were a slam dunk. And so when you zoom out, it really is a facts and circumstances decision. And I've talked with several of my fellow financial advisors within the XY Planning Network about NUA recently. And it's one of those things that sounds great because it's sexy and it's complicated, but it doesn't always pan out. And that's okay, but we need to take a very detailed and nuanced look at this rather than having a myopic view of capital gains rates are lower than ordinary income rates, therefore I should go ahead and implement this strategy. You really need to broaden your outlook and look at it within the whole framework of a financial plan. So hopefully that's helpful. Until next time, see y'all.